Hello guys, welcome to a new video and I hope you all are doing well. And today's video I'm going to discuss how actually you can short a stock in Robinhood. As you may be knowing that there is no direct way to short a stock, but I'm going to discuss three workarounds by which you can actually short a stock. So if you are interested, then please stick around. We're going to discuss all about it. Okay, so before we dig further into the workarounds of how you can short a stock in Robinhood, let's just quickly understand what a shorting is, right? So shorting a stock is exactly opposite of a buying a stock, right? So if you look at the buying a stock graph, right? If you buy a stock, let's say at $10, and let's say after a month the stock is now valued at $100, you made a $90 profit, right? So that's pretty straightforward to understand. When it comes to shorting, it's just exactly opposite to that. So if you look at the graph for how the shorting works, right? You sell something at a higher price and then you buy back something at the lower price, and that becomes your profit. So let's say you sell something at 100 because you expect that the stock would go down, and then when it goes down at $10 you buy it back, right? So that kind of, again, you're making the same $90 profit. It's just the other way around. Okay, so I hope now you are clear how the sorting works. And Robinhood as a platform, right, they do not allow shorting because shorting has unlimited risk. The way it works is kind of a leverage. You are selling something in anticipation. However, if you are wrong, you are liable for a unlimited loss. It's not like it's gonna stop at zero or something, right? A stock can go unlimited up, so there is a unlimited loss potential when it comes to shorting a stock. So it is a very risky kind of a bet. That's why a lot of brokerage firms do not allow this. However, you may find a lot of firms that do allow, and a lot of people do day trading using shorting a stock, but overall it's a risky bet. Okay, so now let's discuss in Robinhood, if you do want to short a stock, what are the ways you can do that, right? So there are three ways which are actually, I would say, safer than directly shorting a stock. The profit potential would be limited, but these are some of the safer options as a workaround if you do want to short a stock. The first option is you simply buying a put, right? So buying a put, how does it work? Let's see that. Okay, so I'm in my Robinhood portfolio. Let's say AMD stock, right? Since it has gone up in a week time, and you think that it would go down in next week or 2 weeks from now, right? So the one way to short this AMD is you buy a put, right, on this. So you go to trade options, you click buy and put, you select the expiration date, which you can say a week from now, so October 20th, and then you, let's say you expect it to go further down from 106, right? So you buy a put anywhere here. So you buy a put, let's say at 102, right? On this you buy a put for October 20th, and if you look at the graph, right, it shows that you have a profit potential of 10,000. So why is that? Because it is expecting that the AMD would go, it's calculating assuming the AMD goes to zero, right? So that's what it's expecting. So but however, your max loss, if you see, right, the max loss in this case is capped. It is capped to the premium that you would pay to buy this put, right? So that's a good thing about buying a put, that you know your max loss in this case, right? So your max loss is fixed. However, your max profit has almost unlimited because stock can go down to zero. In practically it may not. However, it's a possibility that it may go down, right? So that's a way that you can profit by shorting a stock. So as it goes further down, you are going to make profit, right? If you want to visualize how much you can make as it goes further down, right, you can use option strat to actually see a graph for that. So if you check here, right, you can say a long put, right? This is what we did. You can select the AMD here, and you can select whatever we selected there, right? So we selected October 20th as our expiration date, and we did 102, right? So you 102, right? So this is the graph that it comes, right? So as you see here, right, let's say tomorrow, right, some news comes up, and AMD goes down, right? So if AMD goes down to, let's say, 100, right? So you are gonna make you are gonna double your money in like in a day, right? So you spent like 129 is your max loss, so that is what you paid, right? But you gonna make 274, right? So that's basically almost double, right? And as it goes further down, as you can see, right, if MD really goes down to 90, you're gonna make 1,000 bucks, right? You just spent 129 and you made 1,000 bucks. So that's advantage of buying a put. If you expect that the underlying would go down, this is a one way to short that stock. However, you have to keep in mind that theta plays a role here, theta decay. If you don't know what a theta is, I have some videos about it. You can search in my channel. It's basically a time decay, right? So the move has to be quick in this case, because if it doesn't move quick, then you're gonna lose money either way, because theta is gonna eat away your whatever premium that you paid, right? I'm not going too detail on that, because otherwise this video would become long, but I just wanted to quickly give you an insight on the disadvantage of buying a put, right? Because you're racing against the time in case of this. Okay, now let's look at the second way in which you can actually sort a stock. So it's I would say it is not a stock, but you can use inverse. There are inverse ETFs like SQQ, right, which is a inverse of TQQ, which tracks the Nasdaq 100. So it's basically if the market goes up, if the tech sector moves higher, then this goes down, right? So today market was higher, so it went down. However, if the market goes down, if the especially this tracks the tech sector, as the tech sector goes down, this is gonna go up, right? So that is another way you can play the downside of the market, right? So there are other ETFs similar to this, like something like SPSX. So this is kind of a inverse of the S&P 500, right? So if the S&P 500 moves down, this is gonna go up. So today, since it moved up, it went down, right? So it's the inverse of that. So if you look at in a month, right, in a month it has moved almost 8%, right? Why? Because market went down, but this stock went up. So if you had bought something here a month back, you would have made a good profit here, because market was not doing that well. So if you expect the market overall, the market to go down, this is a one way you can short it, right? So and there is not much risk here, because you're just going to hold it, and if the market goes down, you're just gonna sell it. So it's like a buying and selling of a stock. Only thing is you're buying a inverse of something. There are other sector specific inverse ETFs as well, like there is one, this semiconductor, right? So if you expect that the semiconductor market is not gonna perform well, then you can buy this. That's again the same concept. You're gonna see this going up as the semiconductor sector goes down, right? So this is the inverse of bear share for that. Before we move forward to our final one, if you have liked the video so far, please give a thumbs up and subscribe to the channel. That really helps a lot. Okay, now moving on to the last one. So this last one is actually a spread strategy that I'm not going to go into detail here, but I'm just going to I have already a video. I'll link that somewhere in your screen, or I'll put a link in the description as well. This is basically, I'm just taking example of AMD again. It's a call credit spread that you can do. So let's say that you expect that AMD is not gonna go too high, right? So what you can do is you can, let's say for October 20th, right, you can sell a call I'm just gonna go quick on this. Again, as I said, if you want to go and understand this completely, then you can watch out that other video. This is another way to short. It's kind of works well in a neutral to bearish kind of a mode. So how it works is you're gonna buy two things. One is you buy sell call. So you buy a sell, you sell a call at 110, and then you buy a call right above that, right? So that becomes your spread. So in this case, as you see, right, you're capping your profit, but you're capping your loss as well. Also, you do not need too much capital for this, right? You just need $100 to play this option strategy, right? So this is also a strategy that a lot of people use, especially it is very good for a small account. So you can even do this with $100 in your account, right? So if you have $100, you can make $32, which is almost like 30% profit in a very short time, provided that the market goes as you expect, right? It does not cross, the AMD does not shoot up beyond like 110. If that is your thesis, then this strategy also works out very well. So do check out, if you are interested in this playing out this strategy, do check out that video in the description. Okay guys, so those were the three ways in which you can actually short a stock or you can play a bear market. I hope you have liked this, and if you have any questions about any of these strategies, please put your questions down in the comment section. I do reply to all the comments. And again, if you have liked the video, then please subscribe to the channel. That really helps a lot. I'll talk to you in my next video. Happy investing guys. Bye bye.